Hey guys, hope you are all having a fantastic day. I know it's been quite a while since my last video. I was working on the banking video, which at one point literally reached about an hour long, but it was an incredibly frustrating endeavor to put together and make it coherent. You see, when some of the banking companies began to fall, news were coming in throughout the day non-stop. I wrote what was a 5-page essay-like script on Credit Suisse alone, going over their financials to project a thesis that they would be forced into selling into a bigger bank, only for that to quite literally happen not even a week later, which made the entire output of my work quite redundant. As a result of the constant changes and clarifications by the regulators, it became impossible for me to make a video that would offer any value since everything happening was moving incredibly fast. I do have to give props to the Fed and the current administration. Their quick maneuver around the situation was impressive, and I have to give them a lot of credit for quickly moving to secure the money from institutions and people. It was nice to see the system function as it should for once after so many disappointments for years in a row. Though I discarded the entire video, given the resolution of all those events already took point, we are far away from ending the conversations about banks. In fact, now more than ever, I find it necessary to talk about it, because the gears turning around the globe are moving in ways that we did not anticipate would be so sudden. China is enacting serious economic warfare against the West. They are moving aggressively and in hostile fashion to offset the US dollar as the #1 currency in the world. Furthermore, their recent military drills surrounding the small island of Taiwan suggest that they are very serious about the potential escalate their resolve to attain dominance over the country. This is in no way anything to take lightly. The United States has made many statements in the past saying that they would uphold and protect Taiwan, and if they mean that, this could potentially mean a third world war. Now, I know that sounds far-fetched, and it kind of is, but it isn't that hard to imagine as it was 3 years ago. The United States' policy towards China has been incredibly lenient for far too long, and it is about time we start taking drastic measures against a country to dilute it in their self-righteousness that they run concentration camps against Muslims. However, though I applaud the United States' increasing interest in divesting away from China, I am not blind to the consequences that this will have for the entire global economy. The things taking place right now are set to shake off the seats of powers that be in the world, and nobody is going to remain calm and collected when this happens. The events that took place in 2020 with the virus have led to a long chain of events that are now slowly beginning to show us the real picture of what the world is set to look like depending on how America decides to react. I know I have been silent and away for about 2 weeks, but I have not been idle in this time. I have been researching and compiling literally hundreds of news and research and investigative pieces to share them all with you. You guys can expect to have around 3 videos per week for the rest of this month, so don't presume my short absence to have been a quiet departure. There is a whole lot to talk about, so let's just get on with it, and I find no better place to begin this series of videos than with Saudi Arabia, a country so rich that they literally can afford to suppress the entire global media to remain silent on the countless crimes against humanity that they commit. But we are going to skip most of the ethics part and get with the important facts. Saudi Arabia, along with a handful of other countries, shocked the world last Sunday. They announced that they would begin cutting back on their oil production, totaling more than 1 million barrels of oil per day, starting in May. The reason this took the world by storm was because these decisions are typically negotiated in OPEC. Instead, Saudi Arabia, the United Arab Emirates and Iraq all publicly announced this without warning. Brent prices, which is the global benchmark, immediately jumped around $5 immediately. Remember basic economics, the less of a supply in the market, the higher the prices will go. Many are asking why would these countries make such a move? It didn't take long for even reputable journalists to quickly jump the train and blame an under-the-table deal with China, and given the current economic climate, for people to jump on the bandwagon. Now, I am no fan of China, but I like more concrete conclusions based on facts. After some research, I strongly believe that this measure was actually justified after the prices for crude dropped sharply last month. Remember the whole panic when banks like Silicon Valley Bank began to fall? Well, when the entire banking sector got pummeled, it also brought down the oil sector significantly, and that directly affects the deep pockets of countries such as Saudi Arabia, which rely on oil revenue to exist. So how do you go about stabilizing your economy when you have no way of dealing with American banks flipping up? You simply orchestrate a reduction in the output of your most valuable resource export to pump up the prices, bringing some stability back to your economy. I do not want to forego this without also sharing with you the formal statement put out by Saudi Arabia, which said the cuts were a precautionary measure aimed at supporting the stability of the oil markets. They denied accusations that production decisions were made with specific price targets in mind, which I laughed out loud knowing very well that that statement is a hilarious lie. In fact, after the news came out, tons of analysts began to give their own thoughts on the matter, and there was actually, for once, an agreed consensus that the production cuts were made to set up a floor for crude oil prices. Adding to that, crude oil prices are a major driver of gasoline prices, a shocker. As the price of oil goes up, gasoline prices will follow up shortly, only that there is a bit of a delayed response to this which can take up a couple of weeks. This is the reason why gas prices haven't changed much, at least not yet. That's actually the reason why last year we saw oil prices increase, which sent the national average price for gasoline up as much as $5 per gallon. Since then, we have seen gas come back down to around $3.50 per gallon on average. Now, there are fears that gas prices could begin rising yet again, which will have an even bigger effect on the overall economy. When inflation is high as it currently is, wages tend to rise more in response to a spike in oil prices. The more wages rise, the greater the risk for a sustained increase in inflation. This is a phenomenon that dubbed by economists as the second-round effect. If this feedback is large and sustained, a wage price spiral could emerge, and it could easily undo a lot of the progress the Fed has been making so far. Crude oil is a huge economic input, so any significant rise in oil prices will be directly reflected in inflation. Everything will depend on how markets stabilize in the coming weeks. A AAA spokesperson made a statement last week noting that the cost of oil accounts for more than 50% of what they pay for pump, which essentially means that drivers will not catch a break at the pump since that increase will be passed on to the customers. A combination of high oil prices, rising demand, low inventory and market vulnerability pose a huge threat that could result in pumping up prices as high as last summer's record high of $5.02. This would be a long shot to happen, not a guarantee, but these are serious possibilities we now have to contend with as we move forward. And here, I want to shift focus of topic to this week. The last job report we had was stronger than expected, which was honestly not a good look overall. This week is going to be crucial. In the event you haven't looked at the stock market, bulls have been partying for about 2 weeks or so, rallying the markets. From what I see online, the vast majority of people are sort of scratching their heads wondering why exactly stocks are going up with such momentum, especially given that the odds of a rate hike are still high. This contrast and rising confusion have left many investors waiting for this upcoming CPI report, where we will finally add fuel to the rally or pull the rug from deluded bulls. The entire focus will shift away from the jobs market and back to inflation with the CPI report due this Wednesday on April 12th. The report is expected to not be pretty, meaning that analysts expect core CPI to have rises more than the headline CPI, which once again cements the fact that inflation is sticky and that is it here to stay through 2023 and into 2024. From an investor or trader point of view, if the headline CPI matches expectations, or even if it deviates by a tiny bit, the Fed will most likely raise rates by 25 basis points in May. I also read the odds of a Fed rate hike increased from 50% to 70%. Remember that Jerome Powell and the Fed have said their goal is to get the Fed fund rate above 5% no matter what because they want to bring inflation back down to 2%. So even if the report came out better than expected, it is still a high chance the rate hike will still happen, unless the miss on CPI is huge, which is very, very unlikely. The markets have been trying to price in a Fed pause and potential rate cuts, and this isn't going to happen. Again, to be straight and honest with you, the way the markets work is that they are forward-looking. They don't care about the now, they care about the tomorrow. As a result, markets are always trying to price in the moment the Fed will cut rate hikes, so that there is a furious run upwards. This is why, even when bad news come out, stocks remain trading sideways and don't really dip. The reason we went down recently was because of the banking situation, which I am still planning to make a much shorter video on, because we are not out of that hole yet. I recently read some surveys demonstrating that there is substantial economic slowdown occurring at this moment, with not a lot of people paying attention to. The ISM manufacturing data fell down to 46.3 in March, a level that is associated with a recession, something the media still fights tooth and nail to lie about. They are making Richard Nixon blush with jealousy at how well they love denying the obvious. But it doesn't end just there. It's now clear that the Fed will not be conducting quantitative easing because the size of its balance sheet shrinks. And this brings me to my next point. Like I said, markets are forward-looking. Right now, the one and only reason they are going up is because they are optimistic that in 2024, things will get better, so you are seeing a substantial amount of people buying long-term positions, because they are more confident than fearful about the possibility of an upside next year. Countering this are bears, who grow more confident in that the Fed will not be able to significantly reduce inflation below 4% by the end of 2023, and now with added pressure with oil prices going up, higher reports showing people defaulting on payments, and more pressingly, the commercial real estate showing signs of danger, along with fears of a weakening dollar and rising tensions with China, I am having problems finding where the high confidence from bulls is coming from. I mean, even if they are solely looking at earning reports, which are coming soon, there is still plenty of evidence to show that tech is not going to having glowing reports. Just last week, Google said they are having to cut back on tape and staplers, which honestly kind of alarmed me because if this multi-billion-dollar corporation has to cut back on essential supplies, it could mean something ugly might be coming. We are seeing corporations continuing to fire thousands and thousands of employees, and it doesn't seem like this streak is going to end anytime soon either. One thing we really need to look into are the banking earning reports. I really want to see how JP Morgan, Goldman Sachs, Bank of America, Wells Fargo and the many others are doing, because if they themselves show weakness, it will add fuel to a fire that is already at a scary level. Blackstone is reported as denying withdrawals from customers in the billions of dollars, which doesn't inspire confidence. If the banking sector shows troublesome reports and a weak guidance, it could easily instill panic mode. Bulls right now are betting on a rate pause and soft landing. It is not a foolish one, but it is one that is carried up by nothing but hope. It is going to need a serious amount of evidence to support in this week and in the coming earning reports, along with the pace of developments in the future, to really give it credibility, because from where we stand, the stock markets and even the bond markets have warning labels all over. I will be seeing you guys later on Wednesday this week. Make sure to join the Discord if you are looking to get solid day trading results. We alert to the best entries possible, and so far we are pretty consistent, yielding green. It's going to be a very volatile week, so there will be plenty of opportunity to make money. With all that said, I hope to see you on the next one, to the moon.